You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview.
Hey everyone, welcome back to another episode of Market Champions. Today I've got Michael Ashton. Michael is the founder of Enduring Investments. Mike, thank you so much for being on the podcast. It's fantastic to have you on.
I'm honored to be invited to be a market champion.
Yes, sir. Yeah. Mike is also known as the inflation guy for all of you out there. So he's sort of a specialist within the inflation world. And so, that sort of begs the question. So, could you talk about, how you got started in the industry and sort of how you found that niche of specialization, which is sort of dealing with inflation?
Sure. Well, it sort of found me. So I started in the industry in 1990, and I started in the fixed income world, actually for a technical analysis firm in Boston. Came to New York in 93, working for an interbank broker, then went to work for JP Morgan in strategy. Went from Morgan to Bankers Trust and to Deutsche Bank, and then ended up at Barclays. And Barclays at the time that I was there, which was in 2001, 2, 3 timeframe, was styled itself as the inflation house. Now, I had gone there to be the gamma option trader for dollars. So 6 months in options on swaptions and treasury options, agency options, and futures, which was a very exciting job. Always the job I always thought I wanted. But Barclays was the inflation house, and when I had been there for a year or so, maybe 2 years, and they approached me and they said, "Look, we've got this inflation derivatives market in Europe and in London, but we don't have anything in the U.S., which is silly because we have all these tips. We're the inflation house. We feel like we should start this inflation derivatives market. We think you should do it." Because I had a strategy background, had a trading background, I had done some teaching, and I had a popular customer note, and so I was kind of part evangelist anyway, and it sort of made a lot of sense. So I moved from this very exciting world to inflation, where literally nothing was happening. We'd never traded inflation swaps. So I traded the first interbank inflation swaps, where we literally did the trade and then kind of afterwards said, okay, what's the settlement? When are we, do we look back 2 days for the index or 1 day? And how are we doing that? Which was sort of interesting. And that was really, it was neat to be in kind of on the ground floor and to be working on a product that everybody kind of needed and didn't really have. When you're working in options, a lot of what you're doing is, hedge fund business, and it's not clear what you're doing for society. But inflation is something that, lots of people have exposure to it and need a hedge, and there wasn't anything to do, any way to do that. They didn't know how to do it. A lot of people didn't even know whether they should. And so, it was a neat role. I really thought that it should branch out from just hedging headline inflation, which is what you can do pretty much still today, to being able to hedge subcomponent inflation, being able to hedge medical care and things like that. And so I eventually left Barclays, went to Natixis, where I thought we were going to do that. And I worked with Bob Schiller and trying to get stuff done there on subcomponent inflation. And then the global financial crisis hit, and no one was going to do anything exciting. So I left and formed my company, Enduring Investments, with the idea that we would, try to bring innovative inflation products and smart inflation hedging to the masses. Whereupon we had a decade of low and stable and boring inflation. So That's where we are. That's how I became the inflation guy. It was sort of accidental, but once I tripped into it, it was clear that that was kind of where I wanted to be, and doing useful things that were super interesting as well.
Gotcha. And yeah, this last year has been, probably your single most exciting year. So
it certainly has been more interesting to be the inflation guy over the last year or two than it had been for a long time before that. But always before, you were trying to explain to people, hey, look, even though there isn't inflation right now, you have a risk, and you don't hedge things that are going to happen because they're usually too expensive. You hedge risks, especially when you can do it super cheaply. And so I'd show people how they could essentially for free hedge their exposure. And everyone was like, well, we'll call you when we think inflation is going to happen. That's not how it works. But it's a long time in the wilderness. It was a much easier conversation over the last year or two.
Yeah, I know that 100% makes sense. So, I wanted to start off by jumping into sort of the dynamics of how inflation works, and then move on to talk about what's going on today. And so, to sort of kick it off. So, if someone takes sort of a macroeconomics 101 class in university, sort of the theories of inflation that are taught are some combination of, say, demand pull inflation, cost push inflation, and then some amount of money printing, or governments, or boost in aggregate demand without aggregate supply changing, is what causes inflation. And so, I guess as much as this model is, I guess, overall correct, where would sort of your disagreements be with, I guess, conventional macroeconomics, with regards to the various theories of inflation that put out there? What are sort of the theories you adopt and you think are useful? What are sort of the ones that you think are a little bit far-fetched?
Yeah, sure. So when I first started being the inflation guy, before I called myself the inflation guy, back at Barclays, I went back to my economics texts, and so I tried to model things with aggregate supply, aggregate demand, and unemployment, the output gap and all those things. And the answer is it just doesn't work. It has no forecasting ability at all for inflation. And that's partly because you can't forecast the inputs, which makes it hard. But even if you have the inputs, you can't, you can't model the outputs. And so if you actually try to go and build a model of output gap and all these things, the parameterizations of that model change a lot depending on what period that you go and try to parameterize it. So it's useless. And that was really confusing to me, because that's the way I had always learned it, that it happens. And so I cast around for a while and came upon the monetarist model. And like lots of other economists, I said, that's way too simple. It can't possibly be as easy as too much money chasing too few goods. That just can't possibly be the answer. Which, of course, is the reason that all these PhDs who've spent many, hundreds of thousands of dollars getting their PhDs, the reason that they hate the model as well, because it's just too easy.
Yeah.
But it has one characteristic of a model that is really super important, which is if you knew the inputs, you get the outputs. There's a direct connection. And so the next question is, well, can you model money growth? Can you model changes in velocity? And you can model those things a lot more easily than you can model the stuff that goes into your average Keynesian model. So that's where I end up, is that the model that I use is 90% monetarist. So I've topped down what are the big drivers here of, and you can sort of observe money supply. What are the drivers of velocity? So money demand, and that's sort of how I get sort of the big picture. The part of the problem is that you have to then go and try to explain why everyone thinks the other thing works, and why is there this illusion, as it turns out, that high inflation comes with expansion, too fast expansion, and disinflation and deflation comes with, with contraction, recession, and the big answer to that is that most of that effect is energy. Energy does go up in expansions and go down with recessions, but energy also is the main driver of headline inflation. And so if you just look at core, or better yet, median inflation, the correlation almost goes away. And you can also, obviously, there are lots of counter arguments. You can look at the 70s where we had a massive output gap, and yet you still got inflation, and you go, well, the Keynesian model clearly didn't work. What is it? What's wrong? I think that one of the other reasons that people tend to adhere to the Keynesian model is that what it really is it's sort of microeconomics, which we believe very strongly, supply and demand curves, aggregated. And it seems like if we aggregate all these microeconomic supply and demand curves, then we should get aggregate supply and demand. It should work the same way. And the answer, and it doesn't. Part of the reason also is that microeconomics is done in nominal space, and aggregate economics is done in real space, and people aren't good at thinking in real nominal. I could go on for a while, and I probably should just let you ask some more questions, but that's sort of where I end up. I'm mostly a monetarist.
I think it's a good place to start. So I know one of the things that's gone on in terms of monetary economics that's interesting over the last few decades has been, so initially when Milton Friedman and I guess the other monetarist economists put the MV equals PQ, the quantity theory of money equation, together in the 1960s. So from 1960 to at least the mid 1980s, the velocity of money was relatively constant. And so essentially what Milton Friedman and the monetary economists were able to assume was that, okay, if velocity remains constant, well, then the only variable that matters for this PQ portion is going to be the money supply. So if the velocity is constant, the only thing that's going to matter is the money supply. And so what we've observed since 1990, however, has been two things. So one, since 1990, not only has the velocity of money come down, but then one thing that was fascinating that happened in 1990 was Alan Greenspan came out and he talked about how so prior to 1990 they had been targeting some amount of monetary demand as well as monetary supply. But then post 1990, it became very, very difficult to define what money or what the quantity of money was, because there were just way too many different kinds of it. There was US dollars sitting offshore, so on and so forth. And so they sort of switched to Fed funds targeting as opposed to monetary demand and monetary supply targeting. And so in a way, it seemed as if, it seemed as if this monetary theory of inflation had sort of broken down because you saw one sort of this definition of money supply go out the window, and then two, the core assumption of velocity remaining constant. We've seen velocity decline. We've seen the velocity decline since 1990. So putting those two together. So one, what are sort of the reasons behind the decline of velocity, which I think is interesting to discuss. But then two, do you think that sort of invalidates the monetarist model?
So there's a lot in there. So first of all, it's important to know that the original monetarist, Friedman, never said that velocity was constant. A lot of people today say, well, Friedman said it was constant, it's not, therefore he's wrong. He never said it was constant. What he said was, if velocity is constant, then this is true. And velocity wasn't, even back then, it wasn't constant. It was a lot less volatile than it is today, but it wasn't constant. The other thing about the measure of money. So the Fed started targeting the Fed funds rate earlier than 1990. It happened in the mid 80s, but what the Fed was really doing was they were actually taking the Fed funds rate as an indicator of the tightness of reserves in the banking system. What they were still actually targeting money. They still wanted money to go faster, go slower, but because they couldn't get a good read on it, because they didn't have a tight control on it, because first of all, they create bank reserves and banks create the money. Because the money multiplier isn't directly in the Fed's control, they couldn't actually directly control the money supply like the Volcker Fed did and the Fed in the early 80s. So the targeting of the Fed funds was, they really weren't targeting Fed funds except as an indicator that the amount of pressure on reserves from banks was appropriate. And in fact, if you go back and you read some of those early Fed statements, back when they were sort of reporting the statements, you had to speak Fed speak, right? So they'd say, the committee thought that a slightly greater pressure on reserves might be appropriate, and somewhat lesser pressure on reserves could be appropriate or may be appropriate. And the might and may all had meanings, but that was the reason that they targeted Fed funds rate. And then somewhere in the middle, but since then, they decided that the magic is actually the changing of the Fed funds rate. It's not the pressure on reserves. And so now they just target the Fed funds rate and they totally ignore reserves, which means, of course, they have zero control over the money supply. But anyway, back to money velocity, which was a question. So money velocity is not terribly difficult to model. The assumption, it actually over the last couple of years has been more difficult to model because we had something that was very unusual and unique happening. But even then, it's modelable. But there's an extra variable that we never thought we needed. Well, it wasn't as important as it turned out to be. So the way we model monetary velocity is fairly simple. So Friedman said that velocity is the inverse of the demand for real cash balances, and he didn't focus on the supply. So if you thought about something being constant, it was sort of the supply of real cash balances. But the fact that Friedman said that velocity is the inverse of the demand for real cash balances tells you he doesn't think it's constant, because he obviously doesn't think the demand for real cash balances is constant. So what drives the demand for real cash balances? And by real cash balances, we mean literally like zero interest savings. And so there's sort of two big effects. The main effect is the opportunity cost of holding real cash balances. If interest rates are very high in the economy and you're holding zero cash, you don't want to hold very much of it. And so when cash comes into your banking account and that you can own a bond for 12%, you immediately go and buy the bond, right? So and then you're giving it to somebody else who now has the cash and they don't want the cash and they have to do something with it. So you have high velocity of money when you have high interest rates. And so if you look at a correlation from the early 90s until a couple of years ago, when again you had something else weird happening, until 2019, you look at the correlation of money velocity with interest rates, just the 5-year Treasury interest rate, the correlation is like 0.9. And it should be, because as interest rates go down, there was less and less disincentive to hold cash. People would let cash accumulate in their balance, in their savings accounts, and so money velocity came down. And that's a very strong effect. Now, there's another reason that you might hold a lot of cash, and it's been in our model for a while, but it never really mattered very much until it mattered suddenly, and that is that there's a precautionary demand for cash. And regardless of what interest rates are, whatever the other opportunity costs, if you're scared, then you hold more cash. And then, of course, uncertainty about the economic environment is what kind of causes uncertainty. And so more uncertainty causes people to hold more cash and lower money velocity. During the crisis, the COVID crisis, there was sort of an additional thing, and you could sort of model it as being, lots of uncertainty. But what it really was, the Fed or the Treasury just flushed massive amounts of cash into people's bank accounts faster than they could spend it. And so velocity right now is sort of acting a little bit like a pressure release valve, that it kind of like took all this pressure at once, plunged, and now velocity is slowly going back up as people draw down their cash balances to where they really want them to be. Anyway, again, a long answer it's a complex issue, but it's modelable, and it's in fact, although velocity departed from our models over the last couple of years because of the flushing cash issue. Prior to that, we didn't have any problem modeling monetary velocity. It isn't random, and even though it's a plug number in the equation, you can model behavior.
So a couple of things. So with your initial point on velocity not being exactly constant, no, I mean I agree with that. So the volatility was so low that sort of the Milton Friedman statement of inflation is always and everywhere a monetary phenomenon, that was able to hold because the real variable that really mattered was the M, because the V did not matter as much, as you pointed, because it used to be less volatile than it is today. One thing that I did want to ask you was, when it comes to when it comes to defining sort of the money supply in the economy, so how would you go about putting together sort of a monetary aggregate that gives you sort of a reasonable picture of the money supply? Considering that, one, with regards to the data that's available, we have a bunch of different aggregates put together by the Fed. Say, we have M1, M2, M3, and so on and so forth. So, some people use, say, the Fed balance sheet as sort of an indicator of what's going on with the money supply, etc. So, when it comes to thinking about the money supply, how do you put together a good measure or a good indicator of what's going on?
Yeah, that's a great question. And part of the problem with monetarism is that over time, and not in any 6-month or 1 year period, but over time, the definition of monetary aggregate changes. Now, that's not unique to monetarism, right? So the definition of GDP changes as well. We don't measure technology very well at all. So GDP is clearly misstated because intellectual property is just not dealt with well, right? So every economic variable has sort of that same problem, that you have non-stationarity of the definition. The Fed doesn't even calculate M3 anymore. I think the important debate is really between M1, M2, and people who want to use the Fed balance sheet or base money, something like that. And I think that the important distinction is that you want to use a transactional quantity. Looking at the Fed balance sheet, looking at some which includes bank reserves, you can't spend those, and so those that money, it's money, but it's not super useful because it's not measuring transactions in the economy. Whether you use M1 or M2 or M2 augmented by an adjustment for fiscal cash, which is used in different ways these days than it was 20 years ago. Those are transactional, and as long as you've got a velocity of money that coincides with that that particular transactional measure, it doesn't matter that much. I use M2, and I use M2 essentially unadjusted. We're also not trying to target. We're not trying to get a forecast from money of 2.34% inflation, right? I mean, if you get the big figure right, or you get the trend right, then you're most of the way there in terms of forecasting. So I use M2, and we use a velocity of money that's associated with M2, which you can get on the St. Louis Fed's website, or calculate it yourself. Our modeling of one versus the other, we actually adjust the M2 a little bit, but we use pretty close to the actual number. The one adjustment we made in modeling money velocity so we're trying to get out of our model the money velocity that's in the equation. So the St. Louis Fed's M2 money velocity, and when interest rates went to zero, the problem with our belief that the opportunity cost of money, and the level of interest rates therefore drives money velocity, well, you get different behavior around zero, and then you go negative, and you get very strange behavior. So we actually had to make an adjustment a number of years ago to our model to take into account the stock of negative yielding debt. So sort of adjusting that, but by and large, we use mostly the sort of the reported aggregates, and they work pretty well. I prefer a broader aggregate like M2, but I want only transactional definitions of money in my aggregate.
And so when you say transactional elements, you're referring to sort of, I guess, spendable money.
Right.
Okay.
Yeah.
Okay. So one thing that's
cash, demand deposits, checkable deposits, things like that.
No, exactly. And so, one thing that's interesting on that front is if you look at M2 or pretty much any measure of money, you can take the Fed balance sheet or M1 or base money, post the great financial crisis. And one thing that becomes interesting is, one thing that becomes interesting, and a lot of people have criticized both European as well as the American government for this, is we observe the rise in money supply in a way. We observe the rise of the so-called base money, or reserves within the banking system that didn't really trickle into the real economy, and that was sort of coupled with some amount of fiscal austerity. So there's a book called The Paradox of Risk by a guy named Angel Ubide, which sort of really dives into the dynamics behind how post the financial crisis, places like Europe and the US did not have faced a huge amount of fiscal austerity. And that's sort of a big reason behind why we didn't really observe inflation in the past 10 years, prior to say 2021. Big reason for that was the fact that we had fiscal austerity, and the money supply, or the growth in the money supply, did not really make a difference. So how far would you sort of agree with that statement, and where do you sort of stand on that?
Yeah, I don't agree with it at all. I don't think we had, certainly the U.S., we did not have anything that approximated fiscal austerity. But at the time of the financial crisis, I was busy trading inflation swaps and writing a commentary, and I said at the time that as money supply, as base money went up, and this is the reason you don't want to use base money, right? Because the money multiplier is, and then what happened was the money multiplier plunged almost exactly as much as base money went up, and M2 went up 10 or 11% at per annum at its peak, which is still plenty fast enough to get inflation, except for the fact you also had money velocity plunging because interest rates were plunging. And so you put all that together, and it didn't look like you were going to have runaway inflation. And the other thing, so part of the question is, well, how were you able to have that much increase in reserves and not have it translate into M2? So, part of the question is okay, so if you take M2 as given, we kind of got about the right action out of that. Not much inflation. If you don't take M2 as given, and you say, well, you had this massive monetary easing, why didn't M2 go up more? That's a more interesting question. But the answer to that at the time was really obvious. The Fed started paying banks to not lend. That's not the way they phrased it, but they started paying banks to hold excess reserves. Always before, what happened is you give banks reserves, and banks don't make any money on the reserves. It delevers them at some level. Right. And so they would lend up until they became reserve constrained. During the financial crisis, they weren't really reserve constrained anyway. They were capital constrained. And what the Fed really wanted to do was give them way more reserves, essentially, free capital, than they needed. And so they both flushed a lot of reserves in and started paying interest on excess reserves so that banks held it rather than lent it. And that's one of the reasons that you didn't see money supply. It went up 10%. Is not small, but we got up to 13% in the 70s, and we got up recently to 26%. So 10% is a lot, but as long as it wasn't sustained, and it really wasn't sustained for very long. So so that I think is what's different about if you sort of look at all the crises the last 30 years or whatever, what was different about the last crisis was the Fed eased, but the ease wasn't aimed at Main Street. It was aimed at banks. They wanted banks to hold lots of excess reserves because it was the banking system that was in trouble. It wasn't, Main Street obviously ended up being, having lots of problems because banks were in trouble and because of housing and so on. But the real concern was that if the banks start going down like dominoes, then you end up with a 30-year crisis, right? So that's kind of what happened. That was sort of different. Nowadays, kind of fast forward to today, banks are not reserve constrained in any way. They're only capital constrained, which means that the Fed doesn't really have a lot of control over where that money supply goes. They didn't have to worry about that in the GFC, because if banks wanted to lend and that helped Main Street, fine, but that wasn't the important part. Nowadays, it would strike me that if I was a federal an officer in the FOMC, I'd kind of go, gosh, maybe we want a little more control over this whole system, and I would want to start targeting reserves. Unfortunately, there's just too much excess in the system. They can't really control bank lending.
Yeah, I think that makes for sort of an interesting discussion, because because I completely agree that it becomes very difficult to get or to force banks to lend. That was sort of one of the problems that we saw over the last decade. The rate of change within loans and leases for all commercial banks was lower than it was for the decades before the Great Financial Crisis.
What I didn't understand is if you want that number to go up, if you want banks to lend more, stop paying them to not lend, right? Stop paying them interest on excess reserves, and they'll lend more, because the opportunity cost. I mean, if they can earn risk free, they can earn 2% over here, or they can take risk and lend to somebody and lend at a higher rate, but they're taking additional risk. They're
getting compensated to not take that risk. So
exactly, so why not? And so if you want to push banks to lend more, the answer is in my mind, is very simple. Just stop paying them to not lend.
No, but okay. And then one thing that sort of, I guess, contrasts the current situation from what happened in 2008 was the government stepped in, but it stepped in sort of a very different way than it had, say, in 2008. So in 2008, the big sort of discussion was around bank bailouts, TARP and so on. But then, after the pandemic hit, the government sent out the so-called stimmy checks, or the stimulus checks, to millions of Americans. And if you look at, say, personal consumption expenditures, we saw PCE go far out of trend compared to the trend it had over the last say from 2010 to 2019. We saw durable good purchases go up, etc. And so what sort of made me interested was one of the big differences was the way fiscal policy was used, and it was used in a very, very big way, not just in the US, but say here in Canada and parts of Europe, etc. And so a lot of people have argued that a big reason that we've seen inflation post pandemic has been sort of a combination of not just government spending, boosting aggregate demand, shifting the aggregate demand curve outwards. And the aggregate supply curve has also been restricted in the sense that we've seen, supply chain disruptions, etc. And to that end, so one, does this finally validate Keynesian economics, and two, what's sort of your take on what's gone on, sort of post March 2020?
Yeah, so it's interesting if you look at personal consumption expenditures and you plot them against GDP. So you take income on one side, and you take output on the other side, and you look back as long as you want to go. They move in tandem. Right. So because when a business produces a product, they have to pay people to produce the product. The money that you give to the workers is the money that they use to buy the product. Right. And so there's a closed circle. That becomes less and less true when And that remains true when the government runs a deficit, because the government, when they run a deficit, they spend for you, but they take the money from you either in taxes, but then it's not a deficit, or they issue bonds. Okay, so they take the money from people who are saving, right? And so the net amount of money kind of circulating doesn't change. If you look at the COVID crisis, what you see is personal consumption went straight up, GDP went straight down, and that's not possible unless there's somebody stepping in to provide all that money. And so if the government had simply sent checks to everybody but issued bonds, then they would have taken the money right back out, right? They would have issued money to some people and taken money from other people, and you wouldn't have had the huge effect on inflation. But what happened was government runs a $1.5 trillion deficit. The Fed buys $1.5 trillion bonds. That's how you get that gap to open up. And in fact, the size of that gap was just about the same as the amount of money created by the Fed. So I agree that what made the inflation happen the way it did and as fast as it did and was as virulent as it was because fiscal authorities and monetary authorities worked in concert. The monetary authorities printed the money, not directly, but it's distinction without a difference. If every time the government sells a bond, the Fed buys the same number of bonds, it's the same thing, right? So, the Fed effectively printed the money that the government spent. That's a definition of how you create an inflationary crisis, and that's exactly what happened. And it was obvious in March 2020. It was obviously what was happening. And so I think 10-year break evens around that time went to 0.86%. So a 10-year inflation compensation of less than 1% in an environment where the monetary authority was printing money and the government was spending it. It was the easiest trade in the history of trades. It was just obvious you couldn't lose very much even if you were wrong. And of course, break evens went considerably higher than that, with lots of positive carry in the meantime. But anyhow, so I think that you can get an inflationary debacle even with the federal government running close to a balanced budget if the monetary authority just like prints money like crazy. But they tend to move together. And when you get the really bad inflation outcomes, it's when they're doing the same, they're moving the same way. And in fact, if you go back to all the Greenspan testimonies back when he was chairman, one of the things that he would say a lot was, hey, we're okay being loose if the federal government is going to be tight. And we're okay being tight if you guys are loose, but we don't want to be doing the same thing at the same time. And I think that's what really happened in COVID. And now we've got a situation where the monetary authority is trying to be tighter, but the federal government is not being particularly tighter either. And so we're going to have inflation that comes down, but not to where it used to be. Now you're going to ask me about the peak, and you're going to ask me about
that was my next question. So where a lot. So on that note, a lot of people have been talking about a thesis describing inflation as transitory, especially, and sort of the definition of transitory is a little bit unstable, but but the consensus seems to be that inflation sort of goes away by Q2 or so of 2023, and we sort of enter recession around then. Considering what the Fed is doing, we've seen the housing market go down a lot. We've seen manufacturing, industrial production, etc., slow down considerably. And so with all that in mind, they sort of put together an argument that we're going to observe the U.S. enter some sort of a recession, or at least an economic soft spot around Q2 2023. And we're also going to finally get the labor market to start giving some of the tightness or some of the strength that it sort of experienced over the last 12 or so months. So how far do you agree with that view, especially the view that inflation is transitory, and do you finally believe we've sort of entered some sort of secular cycle of inflation that resembles because another big thing that I sort of forgot to mention was people point to stuff like demographics and technology as sort of two big disinflationary forces that sort of impact the bigger picture, that sort of impact the longer term view. And so they're like, okay, in the short run right now, sort of the demand function matters, as well as, supply chain disruptions, whatever. But, on say a 10-year basis, it's going to be back to, thinking about demographics, which are obviously slowing down, not just in the US, but across the world. And then on top of that, looking at stuff like technology, et cetera, that does create sort of a disinflation environment. So, so how far do you agree with that view?
So let's take this in short term to long term. So short term, I've been saying for most of this year that by the early part of 2023 we'd be in recession, and my view of that hasn't changed. I think that you can't have energy prices increase the way they increased and interest rates increase the way they increase and not have a recession. There's nothing in the history books that has those two things happening that did not end in recession. So I've never had a doubt that there's going to be a recession. It looks like we're just about there, as you're starting to see some impact on the labor markets and lots of other things happening. That doesn't have anything to do with inflation. As I said, the growth and inflation are not particularly well linked outside of energy. So take away energy, and I would expect that core inflation is going to come down, not because of recession, but because there were some transitory parts of what we were looking at, particularly on the good side of things. But we've moved a lot of the inflation pressures from goods into core services ex rents, which is where you get people earning wages. And what happens is that once you've had inflation go up for a little while, people start demanding higher wages. Those wages pass back into inflation, to product pricing and service pricing, and that gives inflation momentum. So inflation is coming down. Doesn't really have anything to do with the recession. It has more to do with the fact that money supply growth has come down a lot, but it's not going to go back anywhere close to 2%. It's going to go down, but we still have, we've increased the total money supply 43% or so, and prices are up 16%. And so there's a lot more to be done. So there's a lot of excess, money velocity is going to kind of keep crawling back up and sort of releasing that pressure that kind of got dumped in there all at once. And so that's going to be what confuses everybody next year, is that inflation is going to come down, and it's going to come down to 4 or 5%. In median inflation, and it's not going to go any lower, and people are going to be very confused by that. In the longer term, I agree. Demographics is a big effect. It has been holding inflation down for a long time, as demographics, as the people moved from rural China into urban China, as more women enter the workforce in Latin America, and all those things have increased the supply of labor dramatically over the last 40 years, and they're moving into reverse. And so the supply of labor is going to start to decline, and that's very inflationary. I think that the people who say demographics, an aging population leads to lower inflation, there's literally no evidence for that. The people like to point to Japan. Japan has low inflation because they've been growing the money supply at 2% for the last 40 years. That's the only reason. It has nothing to do with aging. And in fact, if you go to Japan, you'll see very old people working in the as crossing guards because they just don't have any labor. And so that's there was a book out recently called The Great Demographic Reversal that makes the argument so much better than I've ever been able to make it, with really strong quantitative evidence. And one of the points that they make, so the people who say that demographics should lead to lower inflation, say, well, you spend less money as you get older, but that's not true. You spend less money, but your burden on the society is, if anything, it goes up because healthcare. And the fact that government pays for the healthcare as opposed to you has nothing to do with it. Your burden on society goes up, and you're contributing less labor to society. That's dead weight loss, and that means everyone else has got to pay more. That's in terms of technology. Look, I mean, if we had a permanent acceleration in technology growth, then it would be disinflationary. I don't, people made that argument in the 90s. And then after we looked back, we saw that there was really no acceleration in productivity growth. It's not the level of productivity, it's the growth rate of productivity. And so technology always gets better. It's been getting better since before the cotton gin. I mean, and so the question is it faster now than it was 40 years ago? Are things improving faster? And I think it's really hard to make that argument. I mean, maybe it is, but we've been thinking that for a very long time. The internet sensation of the late 90s was a huge increase in productivity, we thought. But when we go back to measure it, it looks like it actually wasn't all that big. And so we always tend to look at these whiz-bang developments, and there are a lot of really amazing things, and say, well, that's it's fundamentally disinflation. AI could fundamentally change the demand for experts and people who do expert services. And that could people have been saying for 100 years that eventually no one will have to work because the machines will do it all. Seems like that we never quite get there. So I that could be disinflationary, but I don't know how to measure that. It doesn't. I'm a little skeptical that it's that big a deal.
I wanted to quickly push back on sort of your point on demographic.
I knew you would because of who you work for.
No, so I wanted to mention one thing that at least that I found or that I've seen that explains inflation or sort of from a statistical standpoint really well has been sort of, say, if you take like a 5-year change in the labor force rate, if you take the 5-year labor force growth and you regress that against inflation, it actually explains inflation very well. And if you look at
it correlates, it doesn't explain, it doesn't lead. It's
but sort of the way that works is, if someone goes into the labor force, so one, not only do they pull back a lot of, not only do they start to earn money, but then when you enter the labor force, for example, you have to and you begin the process of household formation, you have to buy, say, suits, etc. and that is purely for work, and then on top of that you have to buy fridges, televisions, etc. when you form households and so on. And so, as the labor force, and this is, we observed this during the 1970s, when the baby boomers, minorities, and women entered the workforce, we observed a higher rate of inflation. And obviously there are other factors like the energy shock and the food shock, etc. But overall, this was a big part of what drove inflation in the 1970s. And in early 1980s, this peaked and started to come down. And sort of Volcker was very lucky in the fact that he sort of did his hiking all the way up to 20%, when the growth in the labor force sort of peaked and started to come down. And so in a way, he was very, very lucky with regards to the timing. And so at least my argument or my view is that, Volcker is not this, hero who brought down inflation, but more so he's more of some guy who just got very, very lucky that, he came in right when the labor force growth peaked. And then he hiked rates. The rates did absolutely nothing. If anything, they probably made it worse. And then as the demographic rate, as the rate of change came down, inflation came down. And we've observed that coming down for the last roughly 4 decades. And so and that trend is bound to continue. And so your point that the labor force is going to continue to shrink is interesting, because as it continues to shrink, at least this model suggests that inflation should actually continue going down, not up.
Look, that I've seen that chart. It works in the United States. It's coincident. It doesn't admit to any statistical tests of causality at all, and it doesn't apply in lots of other countries. So if you look at Latin America and you try to do the same thing, you don't get the same result. So I've seen that. I think that you need to look at sort of, the global, since we do have, global markets, we do have to look at sort of the global supply of labor. By the way, deglobalization and nearshoring reduces the available supply of labor because we don't use as much of the overseas labor as we used to. And so it's more complex than just looking at U.S. household formation affecting global inflation. But agree to disagree. I'm happy to
for sure.
take the other side of that.
I know for sure. And then I know you. So as
And
we
by the way,
approach the end of our
I've had
interview, so one
exactly
of the
I've had exactly that debate with somebody else that you know well,
yeah,
and it
I know.
ended the same way.
I know. And as we approach the end of our interview, so one of the important things that I wanted to discuss was when it comes to the portfolio construction problem of dealing with inflation, how do you go about actually constructing a portfolio or constructing some sort of, I guess, even a sleeve in your portfolio that deals with inflation? So one, gold has not, gold is sort of, what everyone says is the best inflation hedge, but it's not really done well, especially if you're based in the United States. It's done well against other currencies, but against the US dollar, it hasn't done as well. And one of the trades that has worked, which is sort of a derivative of this, has been the rising rates trade. But that's more of a function of the Fed reacting and actually hiking rates as opposed to inflation dynamics. But that also plays a role. And then on top of that, we've seen some amount of commodities going up, and CTA is having a very, very good year. But overall, when it comes to constructing a portfolio that deals with inflation, how do you think about efficiently how do you think about efficiently sort of hedging the inflation risk?
Yeah. So, and we do this. We design portfolios for individuals and businesses, and the first thing is that we don't look at anything in nominal space. We do all of our work in real space, and so you get a different set of risk and reward trade-offs when you do that. So, in most cases, having inflation-linked bonds as opposed to nominal bonds, it doesn't help in the short term, but kind of helps at the horizon. And so there are things like that. We end up with portfolios that have more of a broad commodity component than we would if we just not modeled in nominal space. Gold works in our models as kind of a long TIPS bond. I mean, it essentially does not. It is very good in the long term at hedging inflation, but it's like a zero coupon TIPS bond. So when real yields go up, gold goes down. When real yields go down, gold goes up. And so for us, it almost kind of drops out because we tend to own a lot of TIPS. And so, gold at times is a cheap TIPS bond. At times it's an expensive TIPS bond, and that's kind of what drives it in our models. Now, the real problem is that there aren't a lot of products out there. What you probably should do if you could do this in putting together a portfolio is put together a portfolio that behaves well at low and stable inflation, and then have a part of your investment that is where you buy inflation options. So at payoff if inflation goes above 4, because when inflation goes above 4, that's when stocks and bonds both go down, everything gets correlated, and your whole portfolio looks awful. So, but there isn't anything like that. There's no product like that. You can't get that product OTC. Banks aren't writing inflation options anymore. Failing that, it would be good to have inflation futures, which we had at one time and we don't currently. We're working very hard right now. I'm more optimistic than I have been in a while that we can get inflation futures to trade again. And if you do get inflation futures to trade again, then you can start creating options and nonlinear exposures to inflation in a portfolio. Because while inflation has a big long-term effect on your portfolio, a lot of that's linear, right? So, if inflation is at 2 or inflation is at 3, or even 4, for a while, that kind of gradually, increases your cost of living and decreases the real value of your portfolio. But a lot of things, in the long run, equities, will, tend to keep up with inflation in the long run.
Yeah.
Bonds will, as inflation goes up, they will respond with higher interest rates. And so if inflation goes up and then comes down, like, from the early 80s, nominal bonds were a terrific investment because inflation was on the downslope. So but the problem is when you get sharp and sustained movements well away from kind of low and stable inflation, 4, 5, 6, 7%. And I believe we're in an environment now where we're going to be in kind of the 4 to 5% range for a while. And that's problematic. We just don't really have a whole lot of investments available that do what I'd like them to do. And so we end up with portfolios that have more inflation-linked bonds than nominal bonds, and more commodities than a lot of people would naturally want to put in. into their portfolios, and we're reasonably active about how we manage those exposures over time.
Got it. Yeah,
A lot of great answers.
And yeah, no one. I know 100%. So hopefully they bring back CPI futures or some sort of direct way for, I guess, more retail investors to sort of play or hedge against inflation, and that would be sort of a very useful tool to have in the toolbox. So Mike, thank you so much for an awesome interview. So this was a great discussion, and sort of you taking the other side of what I believe in. So it's awesome. So it's awesome, and it sort of throws a different light on what's going on and sort of what's been going on over, say, the last 10 years as well. So Mike, thank you so much. Thank you so much for coming on.
Hey, it's been a great discussion. That's what makes a market. I'm delighted to be invited on. As I said, I'm honored. So thanks for the conversation. I appreciate it.